Hi everybody, thanks for tuning in. I'm here to do that April market update for 2022, and there's a lot to unpack here, so I'm going to try to make this a quick video because some big news that happened today. The central bank raised interest rates. In addition to that, I just came back from a really great meeting with CIBC's senior economist Benjamin Tal. He did a presentation for us on behalf of the Mississauga Real Estate Board to give us an update on the global economy, housing, interest rates, all that. Really well done. So I just wanted to send out a quick video while it was still fresh in my head. Also a note on that too, there's like 55,000 realtors in the GTA, and in that room there's only like 150. So kudos to all the realtors that were there that wanted to educate themselves on the market, because it was actually really important. It was a really good presentation, and want to pass that on to the clients. So kudos to everybody that was there. So 3 points I want to talk about today, and I have some notes here, so kind of bear with me, was the Bank of Canada raising interest rates today, the Canadian federal budget and their housing initiatives, the analysis of that, as well as the commentary and breakdown of the analysis of the market with the two major banks, CIBC and BMO. And what does this all mean for house prices? What does this mean for mortgages? Because I'm sure those are the two most important questions that everyone's asking themselves right now. So point number one, banks raised interest rates. The central bank raised interest rates 0.5%. Now their overnight lending rate is 1%. So this follows up with their 0.25% increase that came in March, and they raised rates a little bit more aggressive this time, 0.5%, bringing overnight rate to 1%. Now, insider insight from the presentation today. Benjamin Tal meets with the central bank all the time. So he said that the central bank, their target rate for this year is 3 to 3.5%. Overnight rate right now is 1%. So that's a 2% delta that they want to increase this year. Now, is it going to happen? Maybe, maybe not. And I'll get into that a little bit more in detail. Of course, the central bank wants to rein back inflation because things are kind of getting out of hand. We all know that prices are kind of just running away on themselves. Now, the central banks, they kind of created their own inflation with quantitative easing, like pushing money out into the markets. So they got aggressive with that. Are they going to get aggressive with raising interest rates? They might. They may not. So the point of the presentation on the interest rate was that the central bank has to be very careful on raising interest rates too quickly, because Canadians actually have more debt than the US. So I'm sure you might have seen articles that every dollar a Canadian makes, they're actually indebted on average, not everybody, on average, like $1.75. So there's more debt than there is income. The Bank of Canada has to be careful that they don't shock the market and put people into a position that they can't pay their bills and things like that too. Now, inflation is a lagging indicator, and CIBC, the Bank of Canada might make an error on that, misreading the timing of the interest rate increases. So what I mean by inflation is a lagging indicator. So anything that has happened in the past, we're going to see it now. So they've pushed out all this money with quantitative easing. Now it's showing up. So inflation, from my analysis of it, is the hidden tax. So they do deficit spending, and you're spending money that you don't have, and you pay that back later in inflation. So that's what I'm talking about. Inflation is a lagging indicator. All the money that's been pushed out in the market, you're seeing it now in inflation. It can't be easily taken back, right? Because it's already out there, right? It's in the stocks, it's in real estate, it's in commodities, in crypto, all that. So once again, they have to be very careful on raising interest rates to that aggressive part. CIBC says they're more comfortable with a 2%, maybe 2.5% overnight rate, not the 3.5%. And then at that 2% mark, let the market digest and see how everybody does with rising interest rates and things like that. Now, of course, the Bank of Canada, they're all kind of humans, and humans make mistakes. And it has shown in the past that, especially in the Fed, that when you raise interest rates too quickly, then it shocks the market and you get yourself into a recessionary kind of economic period there. So they want to be very careful on how they raise interest rates. And in my opinion, I feel that they're more interested in Wall Street than Main Street, if you know what I mean. Like, the stock market swings more than real estate. So real estate and inflation, we're more kind of like a slow lumbering giant. It's kind of a lagging indicator. Whereas the stock market, you can swing, on a day. Whereas if anything happens with the housing prices, it kind of takes a while. So I think they're more interested in watching what they do with interest rate increases to what the stock market does. So it'd be very interesting to see if they go past that 2% recommendation from CIBC. So what does this mean for house prices? I don't think that house prices are going to cool off drastically. Like, they're not going to crash at all whatsoever. So if anybody's thinking that house prices are going to crash, I think what they're doing is they're going to price themselves out of the market, right, by analysis paralysis. Because for the market, and I said this in previous videos, for the market to swing negative, like on a crash, it has to be an event bigger than COVID. So with COVID lockdown 1, the market did nothing. It just kind of froze, and everyone had to wait to see what happened. And then nothing happened, and then the market took off, right? So like, if the market to crash, you need an event bigger than COVID. Like the last huge real estate crash was 2008. That's when Lehman Brothers gone, right? So you need like a big bank to fail and just throw like a wrench in the system. I don't think that's going to happen, especially with interest rate increases. Interest rate, they go up and down all the time, and that's a normal thing. So I don't think people should be too shocked when the interest rate goes up a little bit more. That's what mortgages do. They go up and down. If you have a variable rate, in the short term, you probably want to go fixed, but in the long term, 90% of the time, variable always beats fixed for paying down that interest. So, the interest rate increase, does that mean the house price is going to come down? Probably not. Will it cool? It might come back. It's probably going to come back to a balanced market, depending on how much more the interest rate keep going up. And for mortgages, yeah, like if your mortgage is going up because interest rates going up and the house price is going down, your net cash out of pocket is still the same, right? So you're paying less on a house, you're paying more on a mortgage, you're still kind of net same bottom line too. So I wouldn't be too shocked about it. If you feel like you want to lock in, I mean, that's entirely your choice. You have to speak with one of your mortgage advisors to lock in. I did that mistake in 2016. I've seen this happen before. Central bank raised interest rates, boom, boom. I got panicked, locked in my rate, and then interest rates dropped right after that. And it's like, well, now I'm at higher rate. So if you want a variable, if you can stomach interest rates go up and down, then kind of do that. Another interesting point that came up in the meeting today with CIBC is the conflict in Europe. So he touched on, they made a point that the Ukraine's been asking for more economic sanctions on energy and things like that, and of course the US and NATO, they don't really want to do that because they understand that Russia is still a major player in energy, in natural gas and in the oil markets. And that he made a point that Russia could turn Germany's energy off like that, and they don't want to do that. So the sanctions are they're trying to slow things down. But if you look at the real kind of macro, I don't think that's really going to do a lot because so the ruble tanked, but Russia said, okay, if you want to buy oil, you buy it with the ruble that you just devalued, right? So they're kind of making up on that loss there. They have the biggest stockpile of gold. Their partner, China, has the biggest stockpile of gold, the second biggest. It's really important, and they had touched on this in the meeting today. What does China do? Because it seems like they're going to be the next major player, maybe overtake the US in terms of global economy leaders. So just kind of an interesting point there too, because we're seeing gas prices and oil prices come up, and usually, and every time oil prices go up, there's a recession that follows after that. But he showed us a very interesting slide that right now, as oil prices are going up, energy companies they're not investing more in oil, they're investing more in green energy because they understand that green is going to replace black. So they're investing less in oil and more in green technologies because we're getting more efficient in all of the things that we kind of consume today too. So just touching on rising gas prices, is that going to create more of a recessionary thing. In this time, probably not. Like you've seen it maybe in the 70s, for those that remember, when the oil embargo there too, and you had the recession after that. This time it seems a little bit different as per CIBC's analysis. So let's move on to the federal budget. So the federal budget had some very lofty goals and plans for housing, and is that actually going to come to play? Well, let's take a look at this. So they want to, of course, keep immigration targets at 400,000 people coming into the country, or Canadians. Now, interesting point. Here's a pop quiz. Where does the majority of the immigrants come from in Canada? Answer is they come from within Canada. So, for example, students that get their work visas or student visas, they're already in Canada. They just convert that to PR, like permanent residence. So that's where, during the lockdowns, Canada, they still reach their immigration targets, and now they want to keep those targets going. That goes into the supply and demand issue. So we had, of course, a demand shock with supply chain on everything and in housing. BMO says, can we please stop with the supply myth? And this is an article from Better Dwelling. Now, there's a chart that I'm going to be posting here that says that, we are below demand of supply for homes for sale. And actually, we're kind of on par with our neighbors. So is that a supply demand issue? Maybe, maybe not. The federal budget, they want to have, was it 400,000 new homes per year built? Now, here's a question. Anybody who's done renovations, how easy is it to get trades right now? It's pretty hard, right? Like all the trades, they're either too busy or they're too expensive or they're just not existent. So that's what CIBC was saying. Like if you want to build all these homes, who's going to build them, right? So it's like one of those government promises that you kind of pander to votes and things might not actually happen for that. So that was kind of an interesting take on that too. But I mean, I've done tons of renovations in my home, and I know getting trades is extremely difficult. And there's a government program right now for electricians. The government will pay electricians to get free education because there's not enough electricians out there. We need more trades. So for the government to say they're going to build more homes, probably not going to happen. I think the main take of all of this here is house prices are starting to reach a resistance level. So anybody who's familiar with stock technical analysis may understand resistance level. So there's a point where prices can't go up anymore, and it keeps hitting resistance level, and then the market or will do one of three things. It'll break through resistance, it'll consolidate, or start to trend down. I think what we're seeing right now in the market with rising house prices and interest rates going up, we're seeing more of a consolidation, meaning that we're reaching more of a balanced market. I don't see house prices coming down anytime soon. So that's usually what happens in the GTA. Anytime house prices get to a point that we feel it's unsustainable, there's a bit of a cooling, not a crash, where the market goes from a seller's market to a balanced market, which is healthy for real estate. It consolidates for a year or two, and then folks figure it out, and then we were back off to the races. So I think that's really where we're at right now. In the median price range, anything 800 plus, I'm still seeing bidding wars like crazy everywhere. But in the higher $1 million plus range, that's where I'm starting to see the homes not get the bidding wars, the homes missing offer dates, doing price adjustments. And that's kind of in around the 1.6, 1.8 range, especially here in Mississauga, in around that price point. That's where you kind of tapering off. And it's true, like who can afford $1.8 million home? So that's very interesting take there too. So a lot of this price growth is an emotional sentiment, right? Interest rates are low. Folks are seeing other people buying homes, so they buy homes, right? And it's a bit of a FOMO scenario going on, and that's been just going on for years. So I have a book here that I want to show you guys. Extraordinary Property Delusions and the Madness of Crowds. So I don't know if you guys know, I have a small little book club where I post books that I find interesting for financial education. I have a free download of that book too. So that just kind of goes into the mass hysteria and the FOMO of that. So if you see the news saying that house prices are going down and the market's going to crash. That's just the mentality of the consumers changing a bit. But is that actually going to play out in the market? Probably not. So with interest rates increasing, it's just the changing of the psychology of the demand. So it may just go, like I said, from seller's market to more of a balanced market. And I think that's really just what the market needs right now. Unfortunately for home sellers, if it gets to that point, you're not going to get 20% year-over-year house value increases. You might go back to what you're supposed to get, like a bond, 4 or 5%. And I think with that, I think that would put the economy, the housing economy, in a really good place. So I wouldn't be too worried about the housing market in the near future. And the interest rate increases. That's what interest rates do. They go up and they go down, right? And the home prices, yeah, they may come down. Everything's kind of in flux, like gone up a bit. But if we come down for cooling, that's totally good. Are we going to crash? Definitely not. So hopefully this was a kind of a valuable insight. If you guys have any questions, please reach out, reply to this email, leave a comment in the comment section below. Any links that you can follow me on for social media will be below this video here too, as along with the book club. I am more active on Instagram and Facebook versus YouTube here. So if you have any questions, please reach out, and I'll see you folks soon.